The topic of the project is crude oil price prediction. Outline of lecture: 1. Introduction. 2. WHO's Who in global oil markets. 3. Fundamental factors affecting on crude oil prices. 4. Crude oil prices UPS and Downs. 4.1. Rising oil prices. 4.1.1. Cost inflation dampens investment impact. 4.1.2. Rising costs hamper projects. 4.2. Falling oil prices. 5. Crude oil prices. 5.1. A short history of the rise and fall of oil prices. 5.2. So when will crude oil prices rise again? 1. Introduction. Oil is the world economy's most important source of energy and is therefore critical to economic growth. Its value is driven by demand for refined petroleum products, particularly in the transportation sector. Petroleum products power virtually all motor vehicles, aircraft, marine vessels, and trains around the globe. In total, products derived from oil, such as motor gasoline, jet fuel, diesel fuel, and heating oil, supply 33% of all the energy consumed by households, businesses, and manufacturers worldwide. By way of comparison, natural gas and coal supply 22% and 28%, respectively, of the world's energy needs. The principal activities, as illustrated in Figure 4, involved in moving crude oil from its source to the ultimate consumer are: production, which involves finding, extracting, and transporting crude oil; refining, the process by which crude oil is turned into products such as gasoline; and distribution and marketing, which focus on moving those products to final consumers. These activities occur within a global marketplace and extensive physical infrastructure that connects buyers and sellers worldwide, all supported by an international financial market. The physical infrastructure encompasses a vast array of capital, including drilling rigs, pipelines, ports, tankers, barges, trucks, crude oil storage facilities, refineries, product terminals right down to retail storage tanks and gasoline pumps. Who's who in global oil markets? Consumers, Black Circle, individuals, autos and space heating, transportation fleets, trucking, shipping, air, industrials, chemicals and plastics manufacturers, and power generation producers. International oil companies, private, Black Circle, national oil companies, government-controlled, traders, hedgers, speculators, and investors, merchants, firms facilitating physical trade, financial market participants, index investment by pensions, endowments, and others, Black Circle, commodity trading advisors, hedge funds, and individual swap dealers, typically banks and merchants serving customers. Policymakers, demand side, subsidies, taxes, regulation, supply side, OPEC quotas, access, fiscal regimes, market regulation, position limits, reporting. The flowchart is given below.
Many factors influence the formation of oil prices and other energy prices. Physical balancing. Inventories. Supply affected by current conditions and future expectations. 4. Black Circle. Energy prices. Black Circle. OPEC supply capacity. Black Circle. Usable spare capacity. Non-OPEC capacity. Geopolitics. Black Circle. Weather. E&P costs. E&P investments. E&P innovations. Markets and market behavior. Energy prices. Black Circle. Spot. Black Circle. Futures. Black Circle. Options. Black Circle. Spread swaps. Other financial markets. Black Circle. Other commodity prices. Black Circle. Commodity investment. Black Circle. Currency exchange rates. Black Circle. Stocks and other assets. Black Circle. Interest rates. Demand affected by current conditions and future expectations. 4. Black Circle. Energy prices. Black Circle. Economic growth. Black Circle. Industrial production. Black Circle. Goods transport. Personal transport. Black Circle. Weather innovation and energy using equipment. Flowchart is given.
3.1. Supply and demand. Domestic demand and global demand both affect on crude oil price. Over the last decade, emerging markets like China and India have increased demand for crude oil, and so this led many speculators to suggest that demand would outpace supply. On the domestic side, the regular reports from the IEA on refining activity and crude oil supply have direct impact on crude oil price and also crude oil futures price volatility. Released weekly, IEA reports and API reports are often key fundamental influences on crude oil futures markets. 3.2. OPEC output. OPEC, from its name, we all can be sure that its activities will have strong effect on oil market. OPEC production levels and promises for production can also add volatility to crude oil prices. Even a scheduled OPEC meeting and speculation about increases or cuts to oil production can impact crude oil futures markets. 3.3 Weather. That sounds strange that weather can affect oil price, but it will. Storms in the Gulf region of the United States as well as the North Sea can halt production of crude oil both on drilling platforms as well as refineries which may be shut down anticipating the arrival of a bad storm. Events like Hurricane Katrina stand as strong examples of how weather may have a direct impact on crude oil price. You have just viewed some fundamentals that affect on crude oil prices. There are some more but I can't list out here for you because of the limited spaces. Just discover more from the resource. By the way, keep up with the oil and other futures market prices for your investments.
Geopolitical and economic events have driven large movements in world oil prices. The graph is given below.
4. Crude oil prices ups and downs. Oil prices, implications for supply and demand. A dynamic equilibrium of factors. The basic story, as long as supply far outstrips demand, oil prices will stay relatively low. Ultimately, the supply and demand dynamic is the thing to keep an eye on. And expectations matter enormously here. Go down. Greater than whenever new data shows an unexpected boost in oil production or an unexpected drop in oil demand, prices tends to conversely, a surprise drop in supply or a surprise surge in demand will push prices back up. As global production changed relative to demand, the world moved from a period of oversupply, or peak oil, in 1998 to one of undersupply in 1999 and 2000. Inventories are a good means of seeing the imbalance between petroleum production and demand. For example, when production exceeds demand, inventories rise. A large oversupply will put downward pressure on prices, while undersupply will cause prices to rise.
4.1 Rising oil prices. Oil prices have been steadily rising for several years and in June 2008 stand at a record high of $139 per barrel. Is the rise due to a squeeze in availability, peak oil, or are other political or economic factors to blame?
Oil price near $100, but why? Tight crude and product fundamentals push oil near $100/barrel in late November. Resilient demand growth, driven by non-OECD regions' concern over inventory cover ahead of winter demand. OPEC 10 production has fallen, despite rising oil prices. 4.1.1 Cost inflation dampens investment impact.
Tight service sector causes further cost inflation, $35 to $55 per barrel, call option for speculators/OPEC, marginal cost of non-OPEC production influential when OPEC producing flat out, when spare capacity exists, price. OPEC are willing to keep spare capacity off the market is the key.
Rising costs hamper projects. 5. Crude oil prices. Brent crude oil spot prices decreased by $7/b in January to a monthly average of $31/b, the lowest monthly average price since December 2003. Ongoing growth in global oil inventories and uncertainty over future global demand growth continued to put downward pressure on oil prices during January. After growing by an estimated 1.8 million BD in 2015, global oil inventories are forecast to grow by 1.4 million BD in the first quarter of 2016.
Daily changes in crude oil prices were highly correlated with daily changes in global equity indexes. The increased co-movement and higher volatility likely reflect increased uncertainty about future global economic growth. Changes in overall demand for risk assets, such as commodities and equities, by investors and market participants may also be playing a larger role in price discovery across global asset markets compared with previous months.
With global oil inventory builds expected to continue in 2016, upward pressure on crude oil prices will be limited. Forecast Brent prices will average $38/b in 2016, $3/b lower than forecast in last month's STO. The largest inventory builds occur in the first half of 2016, helping keep Brent prices below $40/b through August. Brent prices are forecast to average $50/b in 2017, with upward price pressure concentrated later in that year. At that point, the market is expected to experience small inventory draws, with the possibility of further draws beyond the forecast period. Brent prices are forecast to average $56/b in the fourth quarter of 2017, through the forecast period, compared with $2/b lower than Brent in 2016 and $3/b lower in 2017 in the prior STO. The price parity of WTI with Brent in the forecast period is based on the assumption of competition between the two crudes and the U.S. The current values of futures and options contracts continue to suggest both heightened volatility and high uncertainty in the price outlook. WTI futures contracts for May 2016 delivery, traded during the 5-day period ending February 4, averaged $35/B, while implied volatility averaged 57%. These levels establish the lower and upper limits of the 95% confidence interval for the market's expectations of monthly average WTI prices in May 2016 at $21/B and $58/B, respectively. At this time last year, WTI for May 2015 delivery averaged $52/6, and implied volatility averaged 52%. The corresponding lower and upper limits of the 95% confidence interval were $33/B and $81/B. World crude oil prices. Sources: Bloomberg, Thomson Reuters. Tied by U.S. Energy Tomation Hydration. Updated. My last updated 28/2015 is given below.
5.1 A short history of the rise and fall of oil prices. This wasn't always the case. Between 2010 and 2014, as you can see above, oil demand was soaring around the world as countries recovered from the financial crisis, but global production was struggling to keep up. Many older oil fields were stagnating. Conflicts in places like Libya and Iraq were restricting supply. Countries had to draw down their stockpiles, and prices soared to around $100 per barrel. Those high prices, however, spurred drillers in the United States to use innovative hydraulic fracturing and horizontal drilling techniques to unlock vast quantities of oil from shale formations in places like North Dakota and Texas. U.S. crude oil production has nearly doubled since 2010. Eventually, supply caught up with demand and then surpassed it. That's when the crash came. By mid-2014, global demand was starting to slow down. Europe was still reeling from the Eurozone mess. China's economy was starting to stumble. But the United States continued to produce more and more oil. Iraq and Libya were also starting to bring more production back online. So prices began sliding, down to $70 per barrel. At that point, many people expected Saudi Arabia and other oil producers and OPEC to cut back on their own production to prop up prices, as they have in the past. Surprisingly, that didn't happen. Saudi Arabia decided to increase production in order to maintain its market share, hoping that the subsequent fall in oil prices would crush U.S. frackers, who require higher prices to stay profitable. Ever since Saudi Arabia's decision to maintain output in late 2014, prices have kept tumbling to $50 per barrel, then $40, then $30, largely because supply has remained strong and demand has been weaker than expected. U.S. drillers turned out to be far more adaptable to low oil prices than the Saudis thought, as companies cut costs and boosted productivity in order to keep the oil flowing. Iraq has nearly doubled production since 2014 to more than 4 million barrels per day, as it recovers from conflict. Thanks to the nuclear deal with the U.S., Iran will start exporting more oil this year as sanctions are lifted, offsetting declines elsewhere. Damper on oil consumption. An unusually mild winter helped suppress demand for heating oil. And a stronger dollar means that some countries now have to pay more for crude imports, which further limits consumption. That's the basic story. As long as supply far outstrips demand, oil prices will stay relatively low. On the flip side, crude producers like Saudi Arabia, Russia, and Venezuela are struggling to balance their budgets and suffering from a major revenue crunch. Oil companies in the United States and elsewhere are watching profits evaporate. Banks that financed the U.S. shale boom are reeling from a wave of defaults. Developing nations that previously relied on petrodollars for financing are now hurting. It's a major disruption. 20. Present and future global oil and liquid supply cost curve. Chart is given below. Present and future global oil and liquid supply cost curve. Note: future oil prices will be determined by marginal cost of developing new oil rather than OPEC interventions. North American shale will outcompete many oil sands and Arctic oil projects. Overall cost to produce 1 barrel of crude oil. Graph is given below. Sub $20 Oil Seller Club. 5.2 Falling oil prices. Why crude oil prices keep falling and falling. In one simple chart. For the last 2 years, global oil prices have been in free fall, and no one seems to know when the bungee cord will catch. In June 2014 you had to plunk down $110 to purchase a barrel of Brent crude. By early 2015 that had dropped to $60. Today it costs just $30 to buy that barrel of oil, a level not seen since 2004. It's a breathtaking decline. Dropping? Why are oil's prices? 1. Increased global supply. Global supply of oil has surpassed the global demand, which has resulted in the fall of prices. 2. U.S. oil boom. Oil production in the U.S. has increased as shale oil production has gone up to 4 million barrels per day. As such, U.S. import of oil from OPEC has reduced by half. 3. Increased output from Libya. Because of the civil war in Libya, oil production had decreased to 150,000 to 250,000 barrels per day. It now produces 1 million barrels a day, which may go up to 1.2 million barrels a day by next year. 4. OPEC infighting. There is a rivalry among OPEC members, who are trying to lower prices to maintain their market share. 5. Negative European economic outlook. A slowdown is expected in Eurozone economies in 2015. The growth forecast has been cut down by IMF to 0.8% in 2014 and 1.3% in 2015. 6. Tepid Asian demand. Countries in Asia are reducing oil subsidies, as a result of which oil demand has fallen, which in turn has resulted in increased oil prices, thereby reducing demand. OPEC's surprising response: let prices keep falling. 1. On November 27, a big meeting was held by the cartel. And countries, like Venezuela and Iran, proposed that the cartel, mainly Saudi Arabia, decreases oil production in order to maintain stability in the oil prices. 2. Just to ensure it maintains its market share, Saudi Arabia, the world's largest oil producer, did not agree to reducing oil production and was willing to let prices plummet. Global consequences of falling oil prices. Crux: when oil prices moves up. 1. Inflation increases. 2. Government spending on subsidy increases. 3. Foreign currency reserves reduce. 4. Our export becomes weaker. 5. GDP is affected negatively. 6. Share market crumbles. 7. Investment decreases. 5.3. So when will oil prices rise again? It's a guessing game, and there are lots of plausible guesses. No one knows for sure. Or, if they do, they're laying bets in the financial markets. Greater than some banks project oil prices to keep plummeting down to $20 per barrel this year. Greater than others expect a rebound to around $50 or $60 per barrel by year's end as the U.S. shale boom tapers off and demand recovers. In January, the IEA pointed out that prices could easily slide lower this year. If Iran ramps up production faster than expected, in a scenario whereby Iran adds 600 kilobits/d to the market by mid-year, and other members maintain current output, global oil supply could exceed demand by 1.5 MB/d in the first half of 2016. So the answer to our question is an emphatic ye. It could go lower. Ultimately, the supply and demand dynamic is the thing to keep an eye on. And expectations matter enormously here. Whenever new data shows an unexpected boost in oil production or an unexpected drop in oil demand, prices tend to go down. Conversely, a surprise drop in supply or a surprise surge in demand will push prices back up. So if, say, the Cold War between Saudi Arabia and Iran heats up and somehow leads to conflict that crimps production, prices could rise. So far, that hasn't happened. If low prices are harder for the U.S. shale industry to handle than anyone thought, that could also cause prices to rise higher. If China's economy suddenly rebounds unexpectedly, that could have a similar effect. Or maybe Iran will do something that causes EU and U.S. oil sanctions to snap back into place. Alternatively, perhaps the supply glut, and hence low prices, will persist indefinitely.